Thanks for tuning into this earnings conversation with LTI, and they've come out with their quarterly performance, and it seems rock solid performance. USD revenues quarter on quarter about 5.8%. YOY numbers obviously will look good, but just reading it out, 8.5% YOY. Profits up about 37.9% YOY. In INR terms, it's a 13.7% QOQ growth in net income. Sanjay Jalona would be a happy man. He joins right now to talk about the quarter gone by and the outlook ahead. Sanjay, good having you. Thanks so much for joining in. Congratulations on a good quarter. Hope all is safe.
Thank you. Thank you for having me here.
The pleasure is ours. Sanjay, put the quarter into perspective. I'm seeing this kind of trend of sorts that in what is arguably usually supposed to be a difficult quarter with wage revisions, etc., the sector is turning out and smashing the balls for sixes the way maybe Rishabh Pant did today. Sum up the quarter for us.
Yeah, it was a great story indeed today. I went to bed at India at 89 for 1. What a pleasant surprise in the morning to see India team winning the match. But I think if you look back at LTI, overall, all 4 critical elements of IT services business grew well for us. Our large accounts, growth accounts grew well. Our invest accounts grew well. We opened 22 new accounts, including one Fortune 100 customer, and we announced 2 large deals totaling to $280 million. And COVID has provided enough opportunities for tech companies to help their customers across the ecosystems to adopt to newer models of operations. And I think that has created good opportunities for companies like us, and we're just happy to be there.
Are the large deals a result of some of the partnerships that you've been striking? I mean, the previous one, the last quarter was certainly that. Give us a sense of these, and then I'll talk about the deal pipeline.
So we announced 2 large deals, one in Injazat, which we announced during our analyst day on December 11th, which is the largest deal that LTI has done so far. It is for migration, lead player for migration to cloud. And the second deal is with an oil and gas major to help their next generation ADM services in the new ecosystems with DevOps, etc. Partnerships are a key. Cloud and data and digitization is the main thing that is driving it, and having the partnerships with critical component players is extremely key. So last quarter, in December, we also announced formation of 2 separate units, a cloud unit, a separate team for AWS, Microsoft, and Google, with their entire solutions, pre-sale support, artifacts, etc. And that's helping us get to the premier most position in all 3 of the hyperscalers. So these partnerships are key. We forged a key partnerships with Snowflake. We are the elitist of the levels over there in that partnership, which is the hottest data on cloud company on planet Earth today. So we are very optimistic about that.
Yeah, the deal pipeline seemingly looked very strong, Sanjay. So give us some flavor of whether this is coming in from, I think you mentioned across verticals, but is it coming from across clients, both new and existing account and logos? That is part 1 of my question. Part 2 of my question is, would you reckon that the conversion ratio would look as strong as last year? Because if that happens, the deal TCV would be substantially high, touching in close to that $750 million to $1 billion mark in the next 3 or 4 quarters, I reckon.
Yeah, so the deals are coming from all across. There are deals which are there in existing accounts, plus there are deals in newer accounts as well. There is a lot of activities, as you can imagine, but there is also a lot of delay because the nature of these large deals is such that with teams working remotely, that is leading to delays as well. But given the intensity of the deals that are there, I think we will continue to see the kind of conversion that we have seen in the last year.
Okay, and with the point that new, existing, and across verticals, all accounts participating, I think you've shown there was a statistic that I read in one report which said that over the last 3-4 years, the contribution from your top 20 clients has come off, which is quite admirable that you're de-risking it. Would you reckon that same continues and you kind of remain de-risked in that sense?
Look, I think You have to have a balance. You have to have a balance with large accounts also continuing to grow. See, in an ideal scenario, what we say is if a company has to grow by, say, 20%, you need to have large top 10 accounts need to grow by anywhere from, around 10 to 15%. The invest accounts, these are the accounts which you have opened 12 months, 18 months back, they need to drive predominant growth, grow at 30%. You need to get for a company of our size around $150 million of the business through new accounts. And then you need to change the trajectory by doing some large deals on a regular basis. So that's how we look at it. We don't work, we want to have the large accounts growing as well. You have to draw a balance between how much concentration risk creates versus if they don't grow, it creates a big hole for you to fill from your accounts, which is also not right. So it's a balancing act on both sides.
Okay. Tell us a bit about the operational performance as well, and how do you reckon it would be? I know you reiterated in the past that you would maintain the PAT margins at 14-15%, but Q3, arguably Q4 are supposed to be wage revision quarters. How has it been for you? Does it bring about any kind of issues in Q4 on the operational front if indeed wage hikes are slated to happen? A small bit of flavor there.
Sure. Operational efficiency is key to us. When you operate efficiently, extend all the opportunities, and obviously growing faster gives you an opportunity to invest back into business with increased profits as well. Obviously, COVID's been helpful with travel costs coming down for the company, and it gives an opportunity to increase the profit after tax. But in addition to that, what we have been methodically able to do that we have talked for many years is to systematically reduce the on-site percentages. And our on-site percentages have reduced to a great level at close to 18%. And we have run the utilization up to 84%. We want to bring it down by a percentage point or so. So we are busy hiring and recruiting people. From next quarter onwards, as we called out, there would be increased investments in the two new cloud and data products units that we talked about. We did talk about increasing the investments in sales and marketing to a certain degree, as well as the wage hikes, which will have an impact of around 160 basis points coming from Q4 as well.
Okay, and yet you reckon that you will be able to maintain the operational metrics, not just for the first quarter of the current calendar, but arguably for the year?
See, we as we keep saying, we want to keep the margin at net at between 14 to 15%, and be seen in the marketplace as a growth company. For the first 3 months, first 3 quarters of the year, obviously the margin has run up, but we do expect the investments whereby, for example, wage, we have covered 97% of the employee base. That to have an impact, and our investments in businesses are very important for us to be there. So we want to continue to be seen as a growth company with 14 to 15% as the guided net income.
One question. I mean, I was talking to a few brokerage houses, Citi, for example, and I just want your perspective out here for LTI and maybe for the industry. Last couple of questions, Sanjay. One of them is this: that what kind of guidance, if you will, if not the exact number, but some idea can you give for Q4? Because there is a belief that while 2020 was an aberration year and there was a lot of pent-up demand and wanting to move to digital first led to this coming in bunched up way for Indian IT, Q4 and maybe the quarters ahead might be normalized and not show the hyper growth that we've seen in Q2 and Q3 FY21 for Indian IT. Do you second that, or do you reckon these are unfounded fears?
If I look at our own business, we will have an incremental growth in Q4 over Q3. The quality of pipeline remains to be strong. A large deal pipeline is strong. I'm very happy and excited about the critical conversations that we are having with our customers. Revenue at the end of it is a lagging indicator. It's the conversations that you have with your clients are the leading indicator, and we are excited about those conversations. I have a sense that if we keep investing in the business, if we keep paranoid about bringing value to the customer, there is tremendous opportunity for us to have in the future as well.
Okay, Sanjay, my final question, and I've kind of gleaned this with a couple of your peer set who have all said that, for example, for them, the products and platform business grew tremendously this quarter, much to the surprise. There were a lot of bookings there. And the digital and the cloud business, where you are arguably head and shoulders above a lot of other people, cloud migration, IoT, etc., are all driving growth. You sense that these the rate at which these are growing can continue simply because the world needs to move to the offerings that you are dishing out.
Right now, definitely there is tremendous opportunity for cloud and any IP that anyone can bring to help customers get the time to market advantage for them to move and operate in the new normal. And this is where the products platforms that we are able to bring to our customer will be of tremendous value. Look, I'll give you one simple example. And I think when we speak to companies which are separating from one another, there's a large company which separated from an industrial manufacturing company. They took out one portion and sold it to a private equity. We took them from their systems, combined systems, to a separate new systems, including new analytics platform in flat 9 months. And that time to market advantage, that can only come when you have products and with the services and built on top of it that you can bring to the customer. That's why these things are important in these times.
Well, we wish you all the best for these to continue, Sanjay. Keep up the great work. A splendid show this quarter, and thanks so much for speaking to us today.
Thank you, Neeraj. Pleasure to speak to you.
Likewise. And viewers, thanks for tuning into this broadcast.